Right now, the internet is obsessed with the psychology of money. Finance gurus are everywhere, on YouTube, Instagram, and in books with titles like Think and Grow Rich and The Mindset of Millionaires. They all carry the same message, saying wealth is a choice, poverty is a habit, change your thinking and you change your life. This is absolutely a beautiful idea, and it is one of the most profitable lies ever packaged and sold to the people who can least afford it. But here is what the psychology of money crowd never tells you. The financial system doesn't just respond to your psychology. It was built to exploit it. I am Mr. B. In this episode of Broke by Design, we're going inside the machine that reads your mind. Before we expose the machine, a quick detour through a concept we explored in episode 2. If you haven't seen it, the short version is this. Poverty doesn't just drain your wallet, it physically changes how the brain works. Researchers at Harvard and Princeton published a landmark study showing that financial stress reduces cognitive performance by the equivalent of 13 IQ points, more than a full night without sleep. They called it the bandwidth tax. The mental space that would normally go toward planning, patience, and long-term decision-making gets hijacked by the constant background noise of financial survival. We covered that in depth in episode 2. Go watch it if you haven't. The link is in the description. But here is what episode 2 only touched on. The bandwidth tax isn't just a psychological phenomenon that happens to poor people. It is a known, documented, measurable vulnerability, and an entire industry of financial products was engineered specifically to exploit it. When your cognitive bandwidth is depleted, you are more likely to borrow without fully calculating the true cost. You are more likely to accept terms you would reject on a good day. You are more likely to keep borrowing because the immediate relief feels more real than the distant consequence. The finance gurus call this poor decision-making, the people who designed these products. The weaponization of financial psychology is not new. It has a history, and like most histories on this channel, it follows the same pattern. A gap created by exclusion. An industry that steps into that gap, a system built to extract rather than serve. In the United States, the same redlining and banking exclusion we traced in episode 1 created entire communities with no access to mainstream credit. When those communities needed to borrow for emergencies, equipment, and the basics of economic participation, they had nowhere legitimate to turn. Into that vacuum stepped the first wave of high-interest lenders, loan sharks, pawn shops, check cashers. Informal, largely unregulated, extraordinarily expensive. The Consumer Credit Act in the UK in 1974 was one of the first attempts to regulate consumer lending. It required lenders to disclose the true annual percentage rate of loans. What the act revealed was that informal lenders across Britain were routinely charging rates that would make a payday lender blush. The gap between what banks offered to credit-worthy customers and what everybody else paid was not a market anomaly, it was the market working as designed. By the 1990s and 2000s, high-interest consumer lending had become a formal, listed, regulated industry. Not regulated away from exploitation, but regulated into legitimacy. Payday lenders operated openly on high streets across the United States, the UK, Australia, and Canada. Their target demographic was no mystery. It was the person with depleted bandwidth. The person who needed money before Friday and would pay anything to get it. Let's examine how it actually works. 4 specific mechanisms, each one designed to exploit a known psychological vulnerability. First, the framing trap. Every predatory financial product is framed in terms of the smallest number possible. The payday lender doesn't say, this loan costs 391% annually. It says, just £15 per £100 borrowed. The rent-to-own store doesn't say, this chair costs 3 times its retail price. It says, just £12 a week. The Buy Now, Pay Later app doesn't say, you are taking on 6 simultaneous micro-debts. It says 4 easy payments. The psychology behind this is well documented. Humans are far worse at evaluating percentage costs than flat amounts. The products are specifically engineered around this weakness. Second, the friction removal. Traditional banking is deliberately difficult. Forms, waiting periods, credit checks, branches. This friction, while frustrating to everyone, protects borrowers from impulse decisions. Predatory products eliminate all of it. The payday loan can be approved in minutes. The BNLP checkout adds one click. The loan app on your phone approves you before you've finished reading the terms. In Australia, researchers studying Buy Now, Pay Later found that the products were described by users as feeling like it doesn't feel like that money actually exists. The interface was specifically designed to create that feeling. The friction removal is not a convenience feature, it is an extraction feature. Third, the dark pattern. In Nigeria, researchers documented what UX designers call dark patterns, deceptive features built into the interface of lending apps to push users toward choices that benefit the lender. Hidden fees that only appear after commitment. Interest rates presented as monthly rather than annual figures. Loan amounts pre-filled at the maximum available. Auto-renewal settings turned on by default. One investigation documented Nigerian loan apps issuing loans to users who had abandoned the application halfway through, depositing money into accounts without consent, then demanding repayment with interest. This is not a bug in the system, it is the system. Fourth, the shame and repeat cycle. In Kenya, digital lenders pioneered a particularly aggressive tactic, debt shaming. When borrowers defaulted, lenders would contact every person in the borrower's phone book, family, friends, employers, neighbors, to announce the debt publicly. The psychological pressure of social humiliation forced repayment, even from people who had no means to repay. The Central Bank of Kenya eventually fined lenders for this practice under data protection law, but the underlying mechanism, using the borrower's own social relationships as collateral, had by then spread across West Africa, appearing in Nigeria, Ghana, and beyond. The bandwidth tax makes you borrow. The shame cycle keeps you paying. The finance guru narrative is not accidental. It is enormously useful to the people who profit from the psychology of scarcity. If poverty is a mindset, then the solution is a better mindset. A book, a course, a seminar, priced at $29.99. If poverty is a series of bad habits, the solution is habit correction, tracked in an app, coached by an influencer, monetized at every step. This framing does two things simultaneously. It sells products to people who are struggling, and it insulates the financial system from scrutiny, because if poverty is personal, the system is never the problem. Meanwhile, the actual industry numbers tell a different story. In 2025, the BNPL market in Canada alone was projected to reach $7.5 billion in US. In the UK, the Financial Conduct Authority found that BNPL users were significantly more likely to be in financial difficulty than the general population, and that the products were marketed most heavily at exactly those users. In Nigeria, consumer credit debt climbed to over 4.72 trillion naira by late 2024, driven not by people buying refrigerators, but by people borrowing to cover food, rent, and transport. People borrowing to survive, paying prices designed for people borrowing to consume. The bandwidth tax doesn't just happen to people. It is induced, measured, and monetized. Let's make this concrete, and this time the story comes from two places at once. In Lagos, Nigeria, a woman runs a small tailoring business. She needs fabric to fulfill a large order. Her bank account is short by the equivalent of 2 weeks' income. She downloads a loan app. It's on her phone. It was advertised on Instagram. It promises fast approval. The terms are not clear. The interest rate is presented as a monthly figure. She accepts. She fulfills the order. She makes the money. But the repayment window is shorter than she realized. The monthly rate compounds faster than she calculated. She borrows again to cover the repayment. The cycle begins. Within 4 months, she has 3 simultaneous loan apps active. Her contacts list has been harvested by each of them. When she misses a payment, her mother receives a text message from a stranger announcing her daughter's debt. In Birmingham, a 26-year-old uses a Buy Now, Pay Later app to buy a uniform for a new job. 4 installments. Easy. He does it again for a phone repair, and again for a birthday present. Each transaction feels small. Each one is processed in seconds. He doesn't notice the combined weight until 3 of the payments all fall due in the same week, and his account, which was already stretched, cannot absorb all 3. The late fees trigger. The missed payment notification goes to his credit file. The next time he applies for a rental flat, his credit score has moved. He was not reckless. He was operating in systems specifically designed to make the cost invisible until the moment it became unavoidable. That is not bad psychology on his part. That is expert psychology on the system's part. Here is what the finance gurus are right about and what they get catastrophically wrong. They are right that psychology matters in financial life. The way you think about money, the decisions you make under pressure, the products you choose, all of it has real consequences. They are catastrophically wrong that those decisions are made in a vacuum. They are made inside systems specifically engineered to produce particular outcomes. And the psychology that gets exploited is not a weakness. It is a normal human response to conditions of scarcity and pressure that have been deliberately maintained. Understanding this changes everything. The person who borrowed from a predatory app was not undisciplined. They were precisely targeted. The person drowning in BNPL debt did not fail to budget correctly. They were operating in an interface designed by teams of psychologists whose job was to make the cost invisible. What you can do right now as an individual include: know the annual percentage rate before anything else. Every financial product should be evaluated on its APR, not the weekly payment, not the monthly fee, not the convenient flat amount. In the UK, lenders are legally required to display the representative APR. In Australia, the National Consumer Credit Protection Act requires interest rate disclosure. In Canada, the Criminal Code caps interest rates, but BNPL exploits definitional loopholes. Know what the annual number is before you commit to anything. Treat friction as protection. The deliberate removal of friction from predatory products is a feature, not a convenience. If a loan can be approved in 3 minutes, that speed is not kindness, it is extraction. Take the time the product is trying to remove. Sleep on it. Calculate the total repayment. Compare the APR to alternatives. Use credit unions and community finance organizations. In the UK, credit unions are regulated by the Financial Conduct Authority and cap their interest rates. Responsible Finance, a UK network of community development finance institutions, provides affordable credit to people who cannot access mainstream banking. In the US, credit unions and community development financial institutions serve the same function. In Kenya, SACCOs, Savings and Credit Cooperative Organizations, provide regulated member-owned credit at significantly lower rates than digital lenders. These institutions exist specifically to serve people who have been excluded from the mainstream. They are underused because the predatory alternatives are better marketed. Document every product you use. Screenshot the terms. Note the APR. Record the repayment dates. This is not paranoia. It is the most effective counter to dark pattern design. When the interface is designed to make the true cost invisible, the counter is making it visible to yourself. Report predatory practices. In the UK, the Financial Conduct Authority. In the US, the Consumer Financial Protection Bureau. In Kenya, the Central Bank of Kenya Digital Credit Provider Complaints Process. In Nigeria, the Federal Competition and Consumer Protection Commission. These bodies have limited resources and are frequently outpaced by the industry, but enforcement actions only happen when complaints exist. Your complaint is data. Data drives regulation. The structural solutions, where the real change lives. Regulate BNPL as credit everywhere. In the UK, the Financial Conduct Authority has been reviewing BNPL since 2021 and recommended stronger consumer protections. As of 2025, this regulation is still being implemented. In Australia, BNPL operates under a light-touch regulatory framework compared to traditional credit. In Canada, the federal government has acknowledged the gap but avoided naming BNPL directly in legislation. The consistent pattern globally is that BNPL has expanded faster than the regulatory frameworks designed to govern it, by design. The product was specifically structured to fall below the threshold that triggers consumer credit law. Cap interest rates with real teeth. Several countries have demonstrated this works. The UK capped payday loan costs in 2015. Total cost of credit cannot exceed 100% of the original loan amount. The number of payday borrowers fell significantly after the cap. Germany caps consumer credit interest at 5 times the market rate. Japan has progressively reduced maximum interest rates over decades. In contrast, the U.S. federal government has no interest rate cap, leaving it to states, many of which have none. The data from countries that have capped rates consistently shows the same thing: fewer predatory lenders, not less access to credit. Require psychological transparency in financial product design. This is a newer regulatory frontier. The UK Financial Conduct Authority has moved toward requiring that financial products be assessed not just on their disclosed terms, but on their likely behavioral impact, how the design of the product affects the decisions of the people most likely to use it. This is the regulation that most directly addresses the mechanism, not just disclosing the cost, but requiring the interface to make the cost legible. Several consumer advocacy organizations are currently pushing for this framework to be adopted internationally. Invest in financial infrastructure for excluded communities. The deeper solution is the one that eliminates the demand for predatory products in the first place, not by moralizing about borrowing, but by building the alternative. Community finance, postal banking, public banking options, and genuinely accessible mainstream credit for people with thin or no credit files. These are not utopian proposals. They exist in various forms in various countries. They require political will and public investment to scale. That will and investment are currently absent in most places, and their absence is not an accident. The finance gurus are selling you a mindset, because a mindset is something you can buy from them. The structural changes that would actually shift outcomes, those require pressure on institutions with the power to implement them. That pressure requires people who understand what the machine actually is. You now know what it is. The psychology of money. It's real. Your relationship with money shapes real decisions with real consequences. But the relationship was never between equals. On one side, you, with finite bandwidth, under pressure, trying to survive. On the other side, systems designed by teams of psychologists, UX designers, and behavioral economists whose entire job is to know your vulnerabilities better than you do. That is not a fair fight, but it is a documented one. And documented fights can be challenged. The guru told you to change your mindset. We told you to change the system. Broke by design. Another file opened, another one coming. Until then, read the small print.